Good morning, ladies and gentlemen. Welcome to the Rockwoods Strategic PLC investor presentation. Throughout this recorded presentation, investors will be in a listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so, and these will be available via your Investor Meet Company dashboard. Before we begin, I would like to submit the following poll, which will appear on your screens now. And I would now like to hand you over to Lead Fund Manager Richard Staveley. Good morning, sir.
Good morning, Jake, and hello to everybody that's tuned in today. Thanks very much for taking some interest in Rockwood Strategic. I'm very conscious that there is a mix of people on this call today, those that don't know anything about us, some that have been following us but are yet to buy, and some probably long held shareholders as well. So there's a mix of people, and you'll excuse me where there's some going over old ground, as well as updating everybody on everything that we've been up to. Myself, I've been working now for about 27 years, trained as a chartered accountant, and became a specialist UK smaller companies manager in 2001. So I've been running portfolios for the last 22 years. So the disclaimer you'll all have seen lots of times, but essentially it just says I'm not giving you any, or we're not giving you any investment recommendations or indeed any investment advice, and that past performance isn't a reliable indicator of performance in the future. So what's the summary? Well, Rockwood is a small companies investment trust on the main market of the stock exchange. We target stocks under 250 million market cap, unlike lots of small cap funds that often hold companies well over £1 billion. And indeed, many of our stocks are much smaller than 250 million pounds. We're a specialist fund manager, and the approach we take, we believe, is very differentiated from most other funds. The strategy is proven. I'll show you the performance in a moment. And we're prosecuting this strategy in an efficient market. There's a quote there from the great Howard Marks about that. But what that really means for some of you not too sure is that it's that you regularly get the prices of shares completely misrepresenting the real value of the businesses, because there's just not enough people trading in the shares or looking at the shares or researching the shares than in much more liquid markets. And that opens up opportunities when specialist expertise can be applied to this part of the London stock market. We're targeting 15% IRR investments. That's like annualized internal rate of return over the long term. What that means in English is that we're trying to find stocks that can double over a 3 to 5 year holding period. And if you double your value over 5 years, you end up making 15% a year. Those are the kind of stocks we're looking to do and to target. We're value investors. We care about value. Lots of investors don't as much as us, but we do care in value. We like buying things for less than what we think that they're worth, and we focus on cash flow. We like recovery situations, not exclusively, but there's a lot of them in our fund because often that's where the value is. And we run a concentrated portfolio, so we don't diversify and have hundreds of small cap stocks or lots of small cap stocks. Currently, we've got 18. And we're active. Activism is a slightly controversial word, particularly in terms of how it's done in the United States of America. But we like to take on the whole, much more positive and constructive approach. But we do roll up our sleeves and get involved in these very small companies, either acting as a catalyst for change or helping them to improve, unlock shareholder value or increase shareholder value. The fund is run from Harwood Capital LLP, of which I'm a founder, which was set up by Christopher Mills, who some of you will know, the legendary investor. He's been doing it well over 40 years now. and runs North Atlantic small companies, alongside Nick Mills. They also run Oryx International Growth. And within the Harwood Capital setup, there is also a private equity team who are on their sixth fund, very successful. And that gives us significant private markets perspective, which is relevant for the type of investing that we do at Rockwood, and is not always available to a range of other investors and the types of organizations that they work in. I'm 100% focused on this. It's my only portfolio responsibility, and I'm fully aligned, as is Harwood, with the success of this portfolio. We've bought a significant amount of equity in Rockwood Strategic, and we also have a performance fee if we deliver absolute returns for you as shareholders. Now, small caps, for those that aren't familiar with the area, quick reminder, it's just an amazing source of long-term returns. They call it the small cap effect, probably linked to the fact that smaller companies tend to be able to grow faster than large companies. But also, I think, due to some of the inefficiencies, which captures a valuation effect in small companies, and also possibly a bit of an illiquidity discount, which when unlocked, you then eradicate and can help you deliver your returns. The chart on the left shows you different returns since 1955 averaged out, and you can see on the far right, the NSCI is the Numis Smaller Companies Index, which stands for the bottom 10% of the stock market, which is the second bar from the right. And you can see that materially outperforms the mid cap, the all share, which is dominated by large companies, the actual large company indices, and there's house prices and gilts and treasuries in there as well. What's really interesting is that the final bar is the Numis 1000, which is the very smallest of the small. And you can see this lovely little trend there, which is basically over the long term, you get better returns the smaller you go. So that's why we're doing it. On the right is that fantastic logarithmic scale, which no one ever seems to believe when they see it, but it is accurate information provided by Professors Elroy, Dimpson and Marsh from the London Business School over many years. And what it essentially says, if you invested £1,000 in 1955 in let's pick the large cap index, you'd by now have, by the end of last year, you'd have had £1.25 million with the compounding effect and total returns. But what is very evident from that is you could have had a lot more than 1.2 million quid for your 1,000 if you'd gone smaller and smaller. And indeed, at the top is the return from the very smallest companies, which would mean that you'd have £21 million. It's obviously a very long period of long returns. But I think the point is made is that most people, and we obviously take this view, is should have UK small companies as a permanent feature of their long-term investment planning. The historic performance of Rockwood has been we're very proud of. We're actually to the end of September, I think still today, but definitely to the end of September, we are the top performing smaller companies investment trust over 1, 3 and 5 years. You can see in the bottom part of that chart, we've got our financial year's performance, which runs to March each year, and you can see that we consistently driving an NAV return in excess of the main stock market, which is what you'd expect, both in down years and large years. On the right, there are a few examples historically of stocks that we've invested in that have gone up multiples of our capital, or GN being the most outstanding one with 8.88 times. But what I can say here is that we put these in because it being a stock picking fund and a concentrated portfolio, the returns are pretty much delivered by a handful of our stocks doing particularly well over time. So these are important winners for us. These are some of the winners that have been happening recently. So we've been having quite a lot of takeovers in the last couple of months, 2 or 3 months in the portfolio. And it's not surprising really, because UK smaller companies are in a pretty depressed state with a lack of investor interest, and people are recognizing this, that are off-market participants. Quite a range of them actually. So on the market.com, which most of you will have maybe heard of, the competitor to Rightmove, we bought that relatively recently. That we've got an unrealized IRR, because the deal hasn't completed yet, but it will complete shortly, of 106%. You'll remember that's actually far more than what we're targeting of just 15%, but we're very pleased with the result for on the market.com. That's been purchased by a multi-billion-dollar Nasdaq company that's noticed the misvaluation of the business model of on the market.com. The next is City Pub Company. Again, an investment we made in the last couple of years, actually. That got a lovely little 46% premium to the 3-month average prior to close, prior to the deal being announced. Again, very decent IRR for us. That's been bid by a UK trade buyer, the pub company Young's, which most people should have heard of, primarily based in the southeast, extremely well managed pub co, who've identified, like we did, that City Pub Group had built a really interesting chain of high quality pubs, dominated by freehold sites, which are very difficult to get hold of. The directors kept reminding the stock market that the valuation was at least £160 million, and I think it was valued at about £100 million or so, £110 million prior to the bid. The third is Smooth, which was called ULS Technologies. That's actually been bid for by an Australian listed company. They make conveyancing software for the legal mortgage broking and the whole industry that surrounds a mortgage activity in the UK. Smooth's quite a good example of a stock that didn't really meet our target returns or go quite according to plan. A lot changed after we'd taken our stake. And as a result, we had to sort of roll up our sleeves. We did get engaged with the board heavily, and also with other significant shareholders in Smooth around about how we might sort it out. And we are actually very pleased, given the alternatives in our view, that business is being taken over by the Australians. And we're going to get back just over what we put in for it. That, in my view, would be the kind of a bad outcome for us. But we didn't lose money, and we're focused on very much on that. Finsbury Food, the fourth, that's actually been bid for by private equity, and Finsbury Food, maker of cakes, your Xbox celebration cakes, or the Minions ones, and a range of other sweet treats and bakeries. On the left, the chart there just shows how much private equity dry powder has been building up over the last few years. And is really very significant. We think that private equity has got some of its own problems at the moment as a result of the cost of debt, but overall it still has significant amounts of money to deploy, and we believe they are scouring the UK market for things that public markets are missing, ignoring, and which they're quite happy to take off market and maybe do something with. We were slightly disappointed with the premium paid for Finsbury, but at the end of the day, shareholders accepted it, and we're going to hopefully make an IRR of a good number over 30%. Again, sort of double our target returns. I've put CrestCheck in because that was the biggest one earlier in the year, but I've talked about that enough in previous years to existing shareholders. So where are we with markets? Still huge amounts of noise. It must be very confusing for lots of people about what you do with all this information about whether it be geopolitics, the effect of the autumn statement, what's going on with the Bank of England, or indeed the performance of companies themselves. But I take a relatively simplistic view about this. It's essentially about the monetary cycle. There are other aspects involved. Clearly, it's more complicated than that. But the most important dominant factor is monetary conditions. Monetary conditions are linked, obviously, to inflation, because that's what the banks are targeted to set. And the reality is that they've been tightening for some time, as we all know. Now, the rate. The picture on the left, I think, was a great meme I noticed, and just shows that the rate impact increases that we've been having haven't fully flowed through. I personally know a number of people who can see the impact it's going to have on their personal finances when their mortgages come off out of the deals they set a couple of years, or maybe 3 years ago. But the reality is that pain is still to come for those friends of mine, and it's not just individuals, but it's also for companies that set their debt with their banks a while ago. So we've seen a lot of rate increases, but the impacts haven't fully come through. So the economic environment is going to be pretty tricky during the next 12 months. Why it's taken so long to impact is not just the sort of locking in of rates early, but also the huge amount of help and stimulus that was provided as a result of COVID. The chart on the right, I think, is really good. One of the best, I think, pictorial representations of this, which shows the number of companies entering administration in the UK. And you can see that prior to COVID, on the left-hand side of the chart, there was a sort of general tempo of 100 to 150,000 companies going bust a year in the UK. But obviously we entered COVID, and you can see that actually loads of companies that would probably normally go bust, irrespective of whether there was COVID or not, were basically helped from not going bust. And now that the COVID stimulus is out, you're seeing that starting to mean revert back to normality, and some of those companies are having to sort of face the music that they were kind of given an extended leave of absence on with regards to. And now that's really starting to pick up. So this pain is starting to happen. And that's why, which is obviously very encouraging, it does appear as if we may have reached a peak in interest rates raises in the UK. And for those that follow markets closely, you'll have seen that the actual sentiment and markets have actually improved in the last few weeks. Just a tone of caution. I would say this is definitely a positive factor, but I feel that there's two phases to this. There's the pressure release of interest rates aren't going up any further. But for a full-on bull market to sustain itself, the market has to be able to see that they're coming down on a sustained basis. I'm not sure we're quite there yet. So I think we're still in the zone of quite difficult markets, probably not as difficult as what we've been having. But I would suggest that we're not going to get a sort of full-on bull market until the market in aggregate get to the point of believing interest rates are coming down. It does tend to suggest, the data does tend to suggest that might happen during 2024. And in fact, this chart here shows why that's in terms of stock market history might be the case. Now, I definitely won't be the first UK small cap manager, if you listen to other ones, telling you that the UK shares are really cheap. It's almost getting a bit boring being retold how cheap they all are, and that you should buy as a result of that. I think this chart's actually really good because it shows what happened. It doesn't talk about valuations, it just talks about stock market behavior, but over a very long period, back to 1955. It actually shows the worst 14 years in UK smaller companies back to 1955. Those are the red bars that are down. It's difficult appreciate, by the way, I'm sorry if some people find it a little difficult. The scale's a little bit difficult here, but that's just a function of some of the biggest moves that have happened in markets. But what you can see is that on the right hand side of this chart, 4 or 5 of these years weren't really particularly painful down years at all, really, in UK small company. I mean, down a bit, but we live to fight another day. It's not sort of the end of the world. But clearly, the left hand side of the chart, I would suggest, are quite pretty painful years, including the worst year in here, which is 1974, when the UK small companies fell 50%. The green bars, though, actually show what happened cumulatively over the following 3 years after that difficult year. And I think the truth is that typically difficult periods do afterwards lend themselves to quite strong periods. Within this chart, for those with BDIs, you can see that there are actually 3 separate instances of 2-year periods. So within these 14 years of the worst 14 since 1955, there are a couple of double years. There's 1973, 74, 2001, 2002, which was my first period of managing a fund, which was a mild baptism of fire, but did prepare me a bit better for the other third one, which you can see in there, which was 2008, 2009, the one that we all remember pretty clearly. Well, at least I do, with the great financial crisis. However, in 2007, 2008, where the market fell materially in 2008 after having fallen already in 2007, the following 3 years were very strong. And obviously, we've been through a difficult year in 2022, a difficult year in 2023, and I would suggest the stock market history would indicate that it's quite rare to have a third year in a row. In fact, I haven't found one where you get 3 down years in a row. So we're definitely nearer the end than the beginning, and it's important to be positioned for the recovery in advance rather than trying to say sort of jump in immediately afterwards. So what's our approach in Rockwood? Quick summary for those that don't know us. Well, firstly, the opportunity is this huge, significant universe. So lots and lots of stocks to pick from. Remember, we've only got, we'll typically have between sort of 18 and 25 type holdings. We have a value and recovery mindset, which we think is differentiated from the competition, who tend to get most attracted to very high growth shares. We have growth in our portfolio. It's just typically value and recovery which excites us the most. We do a huge amount of due diligence, and this helps us. This is helped by the fact we have a concentrated portfolio, so we don't have to follow, monitor, and do the work on many more companies than some of our peers. And this engaged approach, we think, actually helps us deliver our target returns. So our active involvement with and engagement with these companies, we help actually helps the share prices do better. What we're typically looking for are proven businesses with identifiable assets. We look for them when the profits are depressed, the profit margins are depressed, where we think the profit margins can mean revert or go back to where they were before, or even better, or roughly where they were. But when the market's given up that that's going to happen, or it's being too short-term focused and thinking it's too far away, that opens up an opportunity for us as medium-term investors to back a medium-term recovery. That typically requires catalysts for change, and we either identify that they're happening already, or we seek to try and create them to unlock the process of recovery, and that regularly involves us engaging with the other stakeholders in the business, which may be the management, or it's always the management, but also the board, and indeed other shareholders. We also develop an exit thesis very much early on. There is no question that the stocks I was just talking about earlier, we didn't have a view that they were going to be attractive takeover targets if the business has kept on delivering. They did keep delivering, and they did get taken over. Even with Smooth, which wasn't a particularly successful investment, we know that the prop tech area is a very fast-moving and growth and underinvested area within that space. So we were aware that lots of people were interested in the position that Smooth had in that market. Again, just fleshing this out just a little bit, we typically look for businesses that come through this sort of life cycle, which we feel we see all again and again in business life. Companies make strategic errors, they make poor M&A, the management get complacent or tired or just plain poor, and it leads to a sort of ineffective operational execution. That lends itself then to a depressed valuation for the shares, possibly and often financial stress on the company. The balance sheet gets wrecked as a result of the acquisition or the lack of cash generation. It becomes highly emotional for shareholders, for the management themselves and the board, because they sort of want to fix it, but they know they're partly to blame. It's all very difficult. There's past decisions that wanted to be that people regret, all that sort of thing. And the dominant narrative is negative. You mentioned the stock down the pub to someone and they just tell you you're absolutely out of your mind. No way, don't go anywhere near that. Have you heard of Nvidia? And that opens up the opportunity for inefficiency and a misunderstanding of the potential that can be driven, and the risk protection that you get from a value investing mindset, which is that you can see sufficient cash flow generation or assets or otherwise. That means that your downside's protected actually at that point of negative sentiment. We develop create a value creation strategy, and the management does too. We replace or enhance or improve the board. There's an operational plan to put it all into execution. We establish how much money we're going to make up front, or roughly how much money we think we're going to make up front. We often get involved with stabilizing the balance sheet or see a route for the company to stabilize its own balance sheet without equity issuance. And once all that's happened, within 3 to 5 years, normally, the valuation rating normalizes in the stock. The returns are improving. Everyone thinks it's sort of doing quite well now, and things have changed. Happy to talk about it in the pub. And we get our exit IRR either through selling to another fund manager if the stock's big enough to be interested to the much bigger funds that that around the market, or to a trade and PE buyout. So, bit of an update now. Apologies for those that are only interested in that, but here we're there now. So, changes afoot in Rockwood's portfolio, change is really exciting. So, these are 8 of our holdings, so nearly half the portfolio. By value, it's just a bit more than half the portfolio. And why have I put these pictures of these characters up? Well, they've all joined the companies that we own in the last, I think now, just over 12 months. This slide is a few weeks old. And we think these people are going to be key catalysts for that recovery turnaround that we talked about. Often, some of our stocks are much more immature, where we have to get things sorted and get people involved to actually start that process of recovering value. But these guys are in place. They're all proven operators and high quality individuals, and we're very excited about them joining the companies. It's typically not on their own as well. So, as you can see on the slide, there's a number of other changes that have been made alongside or by these people to their organizations already. If we take Zilla, Bing Thorne, the bottom left, she's become exec chair of, essentially CEO for now, of M&C Saatchi, the well-known advertising brand. And Zilla's, if you look into her background, it's an excellent CV of value creation for shareholders, of effective business management, both in her last major role at Future PLC, but prior to that as well. And we think she's no nonsense. We think she's diagnosed what needs to happen at M&C Saatchi, and is cracking on with trying to unlock shareholder value, of which there is a lot there. Part of that has to do with cost cutting, and a number of our theses is involved with cost cutting, because we find that as a much lower risk thing for an able businessman to be able to achieve than growth aspirations, which are far more reliant on external factors than cost. Cost you can actually control, and M&C Saatchi has run a federated structure of its agencies around the world, from the Philippines to China to America to Africa, where they have businesses, and they've allowed their business model to be that those businesses have their own sort of finance and supports themselves. And there is a great saving to be made from maybe offering shared services to the group. And that's now, we understand, fully underway with Zilla. The stock market's really given up on the company. It's quite, and we can partly understand why that might be the case, but shareholders, including us, turned down a bid for the stock at £2.20 not that long ago, year and a bit ago. The shares are now about £1.40. And we still stand by why we rejected. We think the shares are worth considerably more than £2.20 and will be valued at that point, some point in the future. A famous business lady and investor called Vin Murrier, who used to run a business called Advanced Computer Software, thinks the same thing, was one of the bidding parties, and still owns her stake in the company alongside one of her investment vehicles, stakes in the business. And we think Zilla will be working on behalf of all shareholders to deliver real value for everybody. And it will be open-minded about how that's created over the medium term. And one of the reasons, which is sort of slightly fair, which is why MC Saatchi's valuation, which is down to about 4 and a bit times EV/EBITDA, and the company's got net cash by the way, is the advertising market itself is actually quite weak at the moment, as you will expect. And MC Saatchi is perceived as just an advertising business, and indeed their largest division is the advertising division by sales, but by profits it's actually not the biggest. It's actually just over 20%, maybe 25% of profits, and they're obviously under pressure and having a difficult time this year. But a huge part of the business is much more strategic communications, which the business has delivered for many years and is highly thought of into national governments, into national organizations like the UN, the World Health Organization. It's involved in passionate, not advertising linked, but kind of sponsorship type of managing sponsorship type creative media for things like Coca-Cola for the Olympics, or the Barclays for the Premiership. And we think actually a lot of it's far more resilient than they're being given credit for, and have been derated alongside some much larger companies. Zilla is in the seat, is in the saddle, and we're excited she's in place now. Those pictures were all people that have come in the last 12 to 15 months, maybe a few months after we bought it, or maybe contiguously. And I've mentioned that we think it'll take them 3 to 5 years to sort things out and get all our returns. These pictures are of people who've been in for a bit longer, who were the equivalent pictures a few years ago. You can see on the far left, obviously, John Duffy, that went into Finsbury Foods quite a long time ago, actually. It's done an amazing job. Sales have gone from 168 million to over 400 million, and that's been a cash generative build with net debt actually falling during that period, margins improving a bit, and that's ended up with the company being taken over. You can also see fantastic margin improvement from losses in Galliford Try's position, through to much better margins in both Galliford Try, Centaur Media, and Van Al. And again, if we take something like Centaur Media, since Swag's become CEO, the business's margins have gone from 5% to, in 2022, 20%, and the market expectations are you should have improved a bit more this year again too. So it's gone from a not very profitable business to a very profitable business under Swag. You'll see in both Centaur Media's case, but also Galliford Try's, that turnaround's led itself to buybacks, not with Centaur Media, apologies, but special dividends in Centaur Media's case, and there have been special dividends at Galliford Try too. And for now, I've got a question mark there, only because we haven't had special dividends or buybacks, or indeed the company being taken over. However, since I did this slide, they have been using that strong balance sheet position that the company's created, having Mark Cutler having moved the business from debt through to net cash, to start making some quite interesting bolt-on acquisitions. and which we expect have a good chance of adding significant shareholder value to the company. And that turnaround that's happened on the market has put the company in a position to start creating shareholder value much better than the company was before. Very briefly, our investment process, some of you might turn off now, so I'm going to keep it literally to one sentence, is we either use our huge network at Harwood to find ideas, but we also do quantitative screening, which is completely unemotional. We then do lots of research, as you'd expect, and that leads itself to either a 2 to 4% position, which we call a springboard or opportunity investment. If we want to do more or take one of those to a bigger investment, we use our investment advisory group, which is a group of highly experienced professional, primarily investors, and then we go to a much bigger position between 5 and 15%. We then engage in that process with the other stakeholders, and then that leads to sort of monitoring and final exit. This is the investment advisory group, and it's on our website. If you're interested in that, do go in there. They're all highly accomplished investors, and I really do benefit from their insights on our portfolio on a regular basis. I mentioned we're engaged. These are just a few of the headlines I sort of pulled from the internet and various publications that link to things that we've been quietly doing behind the scenes or not. I think one thing that I've maybe a flag one, which is Pressure Technologies, which was is the only investment that was made prior to me becoming the manager of Rockwood. It didn't actually work out as the original investors planned, but we've really rolled up our sleeves there. I went onto the board of Pressure Technologies personally earlier this year. We've constructively engaged with them of how to recover and create shareholder value from here. And recently, in line with that constructive engagement, Rockwood has actually extended a loan to Pressure Technologies, the company, which has helped them through a very difficult period for trying to refinance the business, but given them the headroom to start unlocking shareholder value. And that really kind of, I would say, encapsulates the kind of involvement that we get, what we have in our companies, clearly highly differentiated from your average small cap fund approach. And the results speak for themselves. These are our core holdings. So these are the 7 that we have now. RM being the largest and Trifast second. We're going to talk about those in a moment. You can see the portfolio weightings as at the end of September, I think. I just checked that. Well, recently it is roughly the same in all instances on the far left. The second channel is the stake that we have. Just flag here that sometimes other Harwood funds like our idea and have invested at the same time or after us, a couple of instances before us. And when that happens, the stake might be, or our influence on the company that we're invested in, may be higher than just what Rockwood has in Rockwood itself. In RM, Harwood actually owns about 12% in total of Rockwood, including our stake. At Trifast, we're at about 6.2%. Centaur Media, it's actually 29.9% of the company. At Flowtech, it's about 28.5%, maybe nudging 29% now in Flowtech Fluid Power. In Vanel, it's just 5.5%. Same with Pressure Technologies and same with Titan. I'd equally add on top of those big stakes, which allow us influence and a real seat at the table with making sure boards and shareholders listen to us as a major owner of the shares. We also have we proposed a non-executive director to join the board of RM, which both board and shareholders are supportive of. In Trifast, one of the investment team, Nick Mills, joined the board of Trifast just recently. In Centaur Media, I'm on the board of Centaur Media. On Flowtech Fluid Power, one of the members of the Rockwood Investment Advisory Group, Jamie Brooke, is on the board of that. Pressure Technologies I mentioned, and we don't have a board position as I speak at Titan Holdings. You can see the valuations are cheap. You can also, from the next column, you can also see that the market caps are low. So we can go under 250 million. We think that up to about 250 million is where the most inefficiency is in the UK small companies market. But you can see we in our core positions we've gone much lower. I think Titan's one just mentioned. I wasn't going to mention it later. We've got a decent portfolio weighting, a large stake in the business. It's very asset rich. Has net cash. Well, it stated its last results. It has net cash. It also has a Korean subsidiary and associates. Quite a complicated setup that they put in place, which has, we understand, a significant amount of net cash. The business has quite a lot of stock, and it also owns its entire property freehold. The business itself has had sales of roughly about 18 to 19, 20 million of turnover in recent years. We think the profitability of that business can be a lot higher than it has been. In relation to engagement, we are. It's currently. Well, this way. How did I say this? Well, if you decide you want to roast your Sunday lunch and may roast a chicken, there's sort of you need to put some work into the preparation. You need to have a decent quality chicken in the first place. And you need to make sure you've bought it from a good value supermarket, good quality chicken. Then you prepare it properly. Then you need to get it in the oven for the right length of time. And we're getting into the interesting kind of phase of cooking for Titan right now. But that's a smaller position. Trifast, which was flagged in our interim results, was the main position that we've gone up from a springboard position to a core position during the last 6 months. Trifast is a maker of fasteners, which is basically nuts and bolts, but also they do plastics as well. And it's both a manufacturer of them and a distributor of them. Globally, has many locations, and that number might be slightly out of date. I'll explain why in a moment. And a number of high volume manufacturing sites, both in Asia, Europe, and the US. It sold 15 billion parts, so it's not a small concern here, and has well over 1,000 employees. Its actual sales last year were well over nearly 250 million pounds, and it's a profitable business. However, it's also asset rich. It's got a lot of plant and machinery, a decent amount of NAV. However, its returns are depressed, which is what we're looking for in companies. Its return on capital is low, single digit, and its operating margins in 2023 were 5.3%. In the most recent results, they started to actually nudge up. But the company has a target of at least 10% profit margins. We think they can do a bit better than that. But they have a target of 10% profit margins, which would imply on those sales, the business's profits would double on the same level of sales if they can deliver an appropriate level of margin. The sales are very a lot of them are very customer specific and branded products, uneasy to dislodge, and as a result, very long tenure with the top customers, known for their quality, known for their high service levels, their ability to help the customers design what they want, and they often get onto programs, whether it be, I don't know, with Dyson in the consumer area or Ford in auto. Once your fasteners designed in, you're pretty much there until people keep the model drops out. But no particularly large customer concentration. They did a big ERP system, which is basically finished now. It costs them quite a lot of money, it's fair to say, and that's why we think that they really should be able to do slightly better than 10%, which they seem to be able to achieve before, despite not having very good or detailed management information that the ERP system will now give them. Now, restructuring's commenced. We've got a new chair at Trifast, a new CEO. He was actually in one of the pictures earlier, Ian Percival, who we saw only a couple of weeks ago, most recently. But we've also got a new CFO and new COO at Trifast, the catalyst for change. And restructuring's commenced. So that's the reference to my point earlier about the number of sites. So one of the key areas has been the UK region business, which has been underperforming and had too many site locations and wasn't consolidated enough. And what they've been doing is consolidating more than one national distribution centre in the Midlands. And that project is underway now and should complete, we hope, by kind of March next year or around that time. But that will unlock quite a lot of savings for the UK business to help them improve that profitability. Net debt was never really an issue at Trifast. Got a little bit elevated for our liking, but that's now on the way back down again, and definitely into the safe zone by a long way now, we would suggest. And partly that's because under the previous management, the stock position really got very extended. Up to peak about £95 million, which coincidentally is the current market cap, which is quite something to think about when you're talking about asset backing. But £95 million, that's now reducing. It's coming down and converting it itself into cash. They either over-ordered some stock, they weren't managing the slow lines as good as they could, or having the right relationships with customers to make sure they weren't just holding stock for the sake of it. As I mentioned before, Harwood have taken a 6.2% stake, and Nick Mills has gone onto the board. So we feel well in a nice position to engage with the company and deliver for all shareholders in Trifast to create lots of value. And the valuation at 0.6 sales, very simplistically, we would be targeting at least a 1x sales multiple for the Trifast business. That would mean, so sales that, if they don't grow at all, which we think they can grow, would mean a value of £245 million for the business, less any debt. And if we just take the current debt, that gets you down to 215 million of implied market cap. And as I think you can see, the market cap's 95. So that's how we get our expectation that we can at least double our money in Trifast. The next stock is RM. It's the largest stock in the portfolio. They had actually updated the market with some pretty important news right at the end of last week. So for RM watchers, you may be interested in my views you will be interested in my views in this, I hope. And essentially, RM, a very, very interesting business, only 42 million market cap now. We started buying when it was about 27 million market cap. So we've made a decent return already. That said, the shares were a lot higher earlier in the year, and have come back on some soft trading on one of their, not soft trading, some terrible trading in one of their smaller businesses. And I'll come back to that in a moment. So what do? They're in the UK education market. Sales overall are about £200 million. It's been around for many years. Most people in the education sector will have heard of RM. It's a decent brand. They have three divisions, all of which are quite different from each other, but in the education space. The first is what they call resources, which is resources for schools. And that's where this problem child is. They have a very good business in resources called TTS, which is about 80 million of sales roughly, and is profitable. And it's both not only in the UK, it's got such great products like that one you can see on the slide. I think it's called the Optobot, and it helps kids learn how the concepts of coding when they're in primary school, which you can imagine is something that the teachers want to definitely have, or at least the head teachers telling them they've got to have. And TTS, because it designs these quite clever pieces of kit and curriculum aids and teaching aids and a lot of specialist stuff for educators, they make good margins out of that, and it's profitable, and it's gone overseas. So they've got a decent growing overseas part to TTS. But that division's been massively weighed down by their other business called Consortium, which is a much broader set of resources into schools, and without getting into too much detail, loo rolls and crayons and things like that, as much as scrum machines and trampolines. So it's a all singing, all dancing school supplier, and that Consortium business has really been, it appears, fundamentally impaired by a hugely botched IT project, which the previous team of RM embarked upon and went spectacularly wrong last year, opening up the opportunity for Rockwood to buy it very cheaply, and for any people to look at it now, because it is still a very, very cheap share in our view. So, with regards to that, they announced on Friday that they're actually decided they may have explored selling Consortium, but they've decided just to sell it, close it down. And they've announced that it'll be neutral on cash costs to close it down, but they're going to stop the rot and just focus on TTS, which will allow that division to become profitable, and has historically made at least 10% profit margins. So a slightly smaller division, but at least 10%. We'd probably expect a bit more, because TTS, we know, can achieve better than that in that division. The second division is called Assessment. It's a world leader in the marking of exams for everyone from the International Baccalaureate exams to Cambridge Assessment to the ICAEW, and globally as well, sort of everyone from New Zealand's education system, which are world leaders in how they adopt technology in their education system in New Zealand, to other countries overseas. That's a really cracking business, 40 million of sales at last count, and 20% margins. And then they've got a technology division which does outsourcing of IT for schools, 50-60 million of sales. We think the margin there should get up to 8%. That's been on a bit of a turnaround, and that turnaround's been delivered by, yes, no surprises here, a new management team that has happened at RM relatively recently since we've purchased. So we've got a new CEO, which is Mark Cook, who's got a proven track record in transforming businesses. We've got a new CFO, Mark Goodwin, who's recently joined, also actually worked for a period with Mark, so they know each other, which is always quite useful in these situations, and has worked for private equity too. Mark's changed a number of other people, senior people in the business. So they've hired separately another head of transformation, a new head of digital. So lots going on there to try and stabilize this business. We think those three divisions add up to about 180 million pounds, and we think there is huge upside for investors, given that and Rockwood shareholders, given that basically the market cap's 42 million. They do have, though, extended debt at this point, and that's why the shares are where they are. So there's too high debt. But as they reiterated, and I have to say, it's not the first time they've said this in recent months, the banks for RM are fully supportive. They are fully supportive. They understand what we believe is that there's a huge amounts of value here. There's a huge amounts of profit recovery potential, and they are supportive to helping RM through to that. So we think that the business will be able to pay down its debt, either through partly through disposals and partly through its own cash generation, and then that will unlock a massive re-rating of the stock, either through disposals or through on market re-rating, and we should all make our target returns. Springboards and opportunities, just to remind you, those are the smaller ones. These are just some of the logos. There's another slide in a moment. One we bought during the interim period was Restore. Again, just it's a good demonstration of how Rockwood works. We have our core positions, typically the smaller size companies where we buy the big stakes. But if something drops down below 250 million, it gets quite inefficient relatively quickly. Restore, which is an amazing, cracking business that I've followed for many, many years, dropped below and got down to £1.35 literally in the last few months, which is an absolute ludicrous price for Restore. And since then, there's been quickly announced management change, and Charles Skinner, who was the former CEO, has gone back in. I'm delighted to say that the shares are already up at about £2.20. So we've made quite a quick return on some of our capital there, but we think Charles is going to create significantly more value than what £2 than £2.20. So that's a recent opportunity stock position that we've been in to sweat our capital whilst we wait for bigger opportunities in the core positions to invest our money in. Here are some of the other springboards positions that we have. It's not all of them. I'm doing that on purpose because we don't want everyone knowing exactly what we're up to whilst we're up to it, if you know what I mean. On the left-hand side of the chart, you can see, I think this was from Bain & Co. They do an annual survey, an annual big report on the private equity industry. I wouldn't have wanted to be the possibly young, but the sort of junior that was asked to pull the data together to analyze every single global deal between 2010 and 2022 in order to produce this chart. But but Bain in the end came up with this after quite a lot of wailing and gnashing of teeth, I suspect. But you can see here that there is this these are the valuations over quite a long period about what people paid in deal sizes in private equity. And it rose from eight down to 8 times for sub $50 million businesses, up to nearly 13 times for 1 billion plus instances. Again, people prepared to pay a bit higher multiples for slightly bigger businesses, in line with what we talked about right at the start of this meeting. I would just take those multiples on the left of over 8 times and then compare them to the ones of some of the holdings we've got on the right, and would suggest that private equity clearly typically pay a lot more than what the public markets are saying these companies, some of our companies here are worth. We'll talk about one now, which is James Fisher and Sons, a great little UK business. Anyone that's been in small cap for any period of time, professionally at least, probably will have heard of James Fisher. It's actually been around for 175 years. A specialist engineering services business into energy, defense, and renewables and marine markets. Highly cash generative over the years. Built up, became quite a federation, quite a lot of different businesses within those verticals. And now in 18 countries with over 2,000 employees, and in 2022 had over nearly 500 million of sales. But despite all of that, the market is now valuing it at 132 million pounds. And guess what? We think this is a bit of an inefficiency within the UK stock market. It remains obviously profitable business. Now, why is that? Well, in line with the normal life cycle that we see in companies, the prior management team, actually it was prior but one, with James Fisher, got slightly overexcited with the cash generation of the business and went on a little bit of a buying spree with possibly not as quite much acquisition discipline as they should have had, and the business got a bit over levered, and they lost a bit of operational control and probably made a few mistakes along the way. And that led to this, this downturn in fortunes for the company, and clearly the shares. So the margin now is down to 5%, and the new management that's come in, Jean Vernet, now 15 months in as the CEO, formerly a managing director of one of the big divisions of Smiths Group, the FTSE 100 company, has a fantastic long-term CV. In manufacturing services, energy, marine, and turnarounds. He's come in, he's changed quite a lot of senior management. We've got a new CFO starting. That's the most recent announcement just made. He's doing a number of things. He's said that he'll get the margins back to 10, so a bit like Trifast, just a simple 5 to 10 move. He says that knowing that it's going to be extremely hard for them and a lot of hard work to do that. Easy to say, harder to do in practice, but we think it's eminently achievable for the group over the next 2 to 3 years, and that would get themselves back to a mid-teens return on capital in line with their longer-term history. If you look on the far right, you can see the two charts there. You can see the PE average of James Fisher going back 10 years and the EV/EBITDA average. And the EV/EBITDA is pretty interesting here because for quite a few years it was valued at like 12 times EV/EBITDA. The average comes out with, as averages do, at a number which it wasn't the most at, but at 10 times EBITDA. And why I'm labouring this point is you can see from the chart the valuation is a bit depressed relative to history, which is what we like. We've got the catalyst for change, but I think more importantly, we think the business can do about 85 million of EBITDA. We think that's our kind of target profitability return. And for those that are mathematically minded, if we got back to the previous average of 10 times EBITDA, the economic value ascribed to the business would be 850 million pounds. Now, of which you must take off the debt, which is currently high at 150 million pounds. Banks again supportive, so that would take you down to 700 million pounds of market cap if the debt stayed at 150 million. And clearly that is significantly more than 132 million market cap. So that's how we get to how we think we're going to at least achieve our target returns of doubling over the next three to five years. And one of the key areas here is the defence business, which needs sorting out, which has been loss making, and their marine business, which has been low levels of operating margin, but clearly has scope to improve materially. We've got lots of more ideas in the portfolio, and that's good because we've got quite a lot of cash coming in from all these bids. We don't tend to talk about what we're looking at, but suffice to say it's a kind of target-rich environment, as Maverick would say from Top Gun. We just finally, for those that don't know us, £120,000 flat fee is what we're currently charging until the NAV, management fee until the NAV gets to 60 million. And then we charge a 10% performance fee over a 6%, minimum 6% hurdle. And in terms of that alignment, Christopher and I have together acquired 28.5% of Rockwood Strategic shares because we put our money where our mouths are. So I think, Jake, in the interest of time, I'm going to wrap it up there. I could talk about other things, but I think that's it for now.
Perfect. Richard, thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while Richard takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Richard, we obviously did receive a number of pre-submitted questions ahead of today's event, and as you can see there, we have received a number of questions throughout your presentation today as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Richard, if I may now just hand back to you to respond to those questions where appropriate to do so, and then I'll pick up from you at the end. Thank you.
Hi, I'm sorry, by the way, that I've gone on a bit. I wasn't trying to avoid questions, so I'll do these as quickly as many of these as possible, and we'll do written answers for those that I've missed, just for those that have to go. So I've got first one here. In extremis, and assuming all other plans have failed, would one of your strategies ever be to bid for and take private any of your holdings, particularly where you have built up large shareholdings, then hold them as private companies in the portfolio so you have full control over them, where it would possibly give you more options, such as perhaps finding a buyer and selling them, or maybe restructuring at a later date or exit? So the answer to that is no for Rockwood. So specifically, we're not able to own more than 29.9% of any one of our current holdings. So we can't do that. However, we are able to take up to 15% of Rockwood NAV in private holdings. And we're not seeking to invest in private companies like some strategies do, but in a situation where one of our companies went private and we felt it was we were comfortable with how that had happened, we might continue to hold our position within a private vehicle if that whoever had taken it private was happy to do it, so that we would benefit from what you've just mentioned in that regard. It is true to say that Harwood, as I mentioned earlier, has its own private equity funds, which can do and have done a number of take privates. So it's possible, but has never happened, that one of Rockwood's holdings ends up being taken private by private equity. But there's none under consideration, and that hasn't happened yet. Graham R. Hi, are you looking to raise more cash? So the short answer is we are valued roughly around about NAV. We've got an NAV coming out later today. We would like Rockwood to get bigger. And the main reason we'd like it to get bigger is because we actually think it's good for the strategy, not what a traditional fund manager wants to get bigger for, so they can charge more fees. The reality is that with Rockwood at its current size of 50 million, we're clearly showing that we can find lots of stocks to invest in. But as I've said before, the 250 million cutoff point of where we think the market starts to get quite a lot more efficient. With only 50 million under management, we are being constrained in taking active stakes in core in stocks that are, say, 150 million plus, unless one of the other Harwood funds chooses, which is fully in their gift, to get alongside with us. So we'd really like Rockwood to get a bit bigger so that we can take a bigger stakes in stocks that are 150, 125, 175 million, alongside ones that are 50, 30, and 70, 75. Robin has asked, what percentage of holdings you purchase do you take a loss? I don't actually know that number off the top of my head, but I can tell you that in terms of realizing a loss, we've had very few in the recent years. So it probably, I think in my mind's eye, it's probably 20% would be losses. But because it sounds, I'm not ducking the question, but the reality is that because we have long investing cycles, and I've been running this since late September 19, it's not completely, we obviously almost haven't had 50 or 100 investments to give you a really accurate answer to that. I think what I would say is something like Smooth, which didn't go right. We got our money back, or slightly more actually than our money back. Bond Hill was another one that didn't go well for us. And in Bond Hill, we kind of nearly got our money. I think got 95% of our money back. So what we're trying to do is not have really big. We haven't had any major negative ones since I've been managing the portfolio. Richard F. The total expense ratio quoted on my screen is 2.85. That makes the fund look expensive. Could you give some comment on this? I'm really pleased Richard F's asked that question. It's really irritating us. Remember that we're Harwood. We don't have a huge team of marketing people ringing up all the different systems all the time. We try and do our best, but we really don't have that kind of team. Regularly, the Rockwood expenses are being misquoted on some of the screens. And the reason is because we have had some one-off costs, which aren't really fair to put in as the ongoing expense or the cost of the fund in both the last 2 years. So last year, we actually moved the fund from AIM to the main market. That made sure that we weren't being charged capital gains tax, believe it or not, which the fund was previously structured on under, if you're on AIM, to pay tax on our gains, which have been horrific for Rockwood shareholders. So it was the right decision to move from AIM to main. That had a cost of doing that, and many of the platforms just don't seem to be able to adjust for it, even though we flag it. We believe our ongoing expense ratio currently is 1.48, if that's helpful, which is much lower than your 2.85. I would just notice our performance fee, that's a 1.48 is pre-performance fees. our performance fee can then increase that 1.48 if we do a good job. I feel very passionately that Rockwood is a great example. If you look at the returns we've delivered over time, which are all net of performance fees, that any fees that are related to that really are justified and more than payable, given the actual returns that are then generated for shareholders. Right, I'm going to read this out without quite knowing where it goes. Open-ended flows amongst UK small cap vehicles in aggregate have been very challenging. You're obviously hunting primarily in market caps below where most of the OICs typically allocate, but just wondering if there was any general trend you've observed within your book on relative performance by market cap X takeovers. Yeah, most of the open-endeds are bigger. I think what's interesting in this most recent kind of improvement in sentiment, you've had actually the slightly larger, more liquid small caps seem to have sort of perked up slightly better than the smallest. Obviously, AIM is performing worse than the FTSE small cap, which is interesting. Although the FTSE small cap index is quite a narrow index, it only has just over 100 companies, ex-investment trusts. So we don't. But I think the open-ended flows have been a real issue. I don't know whether you guys can still see the slides, but I kind of skimmed over it earlier. But that chart there on the bottom right of slide 22 just shows you how bad it's been. And in summary, Callum, it's like it's basically a buyer's market. You know, they've all been having outflows out of UK small cap, and as a result, if you can get the other side of that and pick it up, alongside what you see as a more either strategic investor or large sophisticated private investors who are not subject to open-ended flows, or even people with more permanent style capital vehicles, vehicle money, they're tending to sort of hold up better. I failed to mention, but an important point, for instance, although we've been buying RM, there is a slightly unclear other party that we have never had no contact with at all, who has bought now nearly 17% of RM as well in the last sort of 12% last 12 months. Sorry, last 12 months. And you know, that's probably soaked up quite a lot of open-ended sales. So you have to be quite careful, but no particular trend as yet that I've noticed. So apologies, I haven't got that for you. Generally speaking, it's also from Canada. Generally speaking, do you see greater opportunities for margin expansion within portfolio companies at this time from cost cutting, price increases, capex roll-off, or other sources? Yeah, so it's the margin opportunities are typically from getting rid of loss makers. So, for instance, M&C Saatchi has a few agencies that are definitely loss making. Pretty sure Zilla's not going to allow that to last for long, and that just mathematically improves your margins. Quite a lot of cost cutting across the portfolio, whether that be Flowtech, Fluid Power, Trifast, Fishers. Who else? Restore has been taking costs out. Hostmore has been taking costs out. Less capex. The capex terms are quite positive now, courtesy of Mr. Sunak. And most of our companies are either pretty well invested or not having their capex restricted. We're very comfortable with companies investing in that. Price increases have been. The day for material price increases has probably passed. I think the environment is still probably conducive to be able to put further prices through. A couple of our companies haven't done it as well as they should have done, which is why there's been change. So there's a bit of catch up in some of ours, but those are the main drivers. Lisa O, can you talk a bit about collaboration with other Harwood trusts? It seems you have some overlap in positions. That seems positive. Can you elaborate? Yep. So Harwood's a very vibrant ecosystem. Nick Mills, who's the co-manager of Oryx, sits opposite me. Christopher Mills in the next room. Edesian Capital, which is 50% owned by Harwood, is on the floor above us in the same building, and obviously Christopher manages North Atlantic. I would say we're not into committees at Harwood. In fact, there aren't any. Not that I'm aware of anyway. So there's, and we all love investment and making money. So occasionally the funds do have a kind of, synergistic kind of overlap, like a Venn diagram, where we end up owning the same stock. I mean, there's only one example where all of them do, and it's actually Flowtech Fluid Power. So that's the one where everyone's got that, which is why we've got such a big holding in. More regularly though, it's just a handful. So in Rockwood, I think it's 4 or 5 that are owned in other Harwood holdings. I'm delighted to say that's probably maybe even 60-40 with regard to things that we've bought and then Harwood have bought, and then 40% things that, so Christopher, for instance, had invested in onthemarket.com, and then I thought it was appropriate for Rockwood as well. We're all trying to achieve the same thing, which is grow wealth. You can imagine that North Atlantic is a £700 million fund, has slightly different, and a lot of private investments, slightly different objectives, or than Rockwood. Oryx International Growth is more open to a wider range of special situations, has a decent healthcare bias. There's no healthcare currently in Rockwood. So hopefully that's helpful for you, Lisa. Alex D, interesting. Most of the recent deals seem to be from trade buyers. Do you feel that PE is being temporarily priced out by the increased cost of debt? I think there's probably for some players there's an element of that. I think it's possibly because some of the PE guys have been more just focused on their existing investments that they're trying to source out, maybe than making new ones, possibly. I think the debt piece some people are overplaying that. It's definitely an issue for PE in as much as they probably were able to put more turns of debt into a deal before, where we are with interest rates where they are and the banking environment where it is, than they are right now. They still will be able to put leverage in. So I think, and to an extent, if you think about what makes up a private equity return on their investment, you have the low multiple that they pay, the operational improvement, and then the leverage piece, and then you obviously get your exit at the end. And I think that the multiples, to some extent, will be offsetting the increased cost of debt. I also think that some of the cleverer ones will work out they can refi during their holding period, maybe improve the debt. So whilst it looks expensive now, it may not be the debt that they have all the way through to completion. So we're expecting PE to come in on a number of things over the next 12 months. In the wider market and probably in Rockwood portfolio, I wouldn't be surprised too. I just actually, in that regard, if you can still see the slides, there was one I hadn't had a chance to do, which was this one. And again, I hope this is big enough for people to see. But this is showing the actual returns, the median returns of the grey bars of the private equity industry, depending on the year in which the deal was done. So what happened over the next few years from those deals. And what it essentially is showing is that the best returns from private equity typically occurred from, in the last cycle, started occurring from 2009, in the previous cycle from 2001. So we would suggest this is a sort of point in the cycle where they're going to start to want to deploy capital if they think it's going to be anything like previous cycles. That question about, there's a question there I think I've answered already. There's been a couple of questions about marginal buyers. I think the marginal buyers will need to be twofold. Firstly, when a fund manager gets a takeover, which say, for instance, we've had from Finsbury Foods, that's the first one that's going to drop into Rockwood Holding. I'm quite emboldened to reinvest that capital. So we're getting money recycled from takeovers that you can recycle. For those that are getting outflows, maybe some has to go into the outflow, but the rest will be recycled in the company. Secondly, I was one of the signatures in the letter to the Times prior to the autumn statement about trying to encourage the government to to create a British ISA. All of you that love investment, please sign up to any initiatives you see, or tell your MPs or anyone else you think that might be listening. We think it would be a great idea that ISAs, which is a great tax break, I'm sure many of you have them, basically is focused on that tax break for people that invest in small British businesses. I think that makes a lot of sense, and a lot of people signed up to that letter. So maybe we can create a bit of a marginal buyer from that. You'll be well aware that the Mansion House reforms announced earlier this year include AIM, and although they'll be slow to move those large insurance companies, we expect that to probably lead to some flows onto AIM from the large insurance companies, multi-billions, eventually onto it. And there's no reason why the Americans and other global asset allocators, or the hedgies, might decide strategically that's enough been enough, there's too much value on offer in UK, and we're just going to allocate a bit more money to UK. What would be great would just be the rot to stop. So the pension funds move to global has pretty much happened. It used to be 50, 60%. It's now very, very low. So i.e. just can't go any lower. And secondly, the move to bonds versus equities is pretty much played out. So from a structural perspective. So that in itself is probably helpful. Jeff Jays asks, how do you influence the choice of new management at businesses? Well, there's two ways. Number one, we actually actively go and find candidates for businesses and propose them to their companies and boards. Secondly, we do the same, but at board level, where we find trusted people who we think really understand shareholder value and what good looks like to go on the boards, and then be part of the process of selecting a management. In a number of instances, we're asked for feedback. We were prepared to become inside, meet the candidate, and then give them feedback as part of their process because we're a large shareholder. So that's typically how it happens. The other way around is a more easy or a difficult conversation to have, but reality is that with our large stakeholdings and often support from other investors, we can push for change relatively quickly if we think someone's not doing a good job. Richard F, if you suddenly found that you wanted to take a bigger stake in one of your companies, would you have to sell one of your other Springboard stocks, or have you got other funding options? It's never been a problem. We manage the cash really well around that. In extremis, we might do that actually, and one of the most liquid stocks, we might temporarily do that. It's very, very rare I could see that happening. As I said, right now we're about to have 23% of the portfolio convert into cash over the next 4 to 5 weeks, which for redeployment. So it's not an issue we're about to come up against. Alex D, interest is set to ratchet up quite quickly on James Fisher's refinancing. Does the business have enough room to maneuver in the short term, in your view? Well, it's fair to say we're not close enough to James Fisher right now to know exactly where they are or what is being proposed around their refinancing. What we do know is the business has a long history of cash generation. We know that it has a lot of hard assets and very clear subsidiaries which have value, are performing extremely well, and generate lots of cash, and thus the options available regarding the James Fisher's refinance, a bit like RM's, are that they can make commitments to the banks about realizing further value in the portfolio to pay down the debt, alongside establishing a refinancing around their current and likely future cash generation abilities once the turnaround's been successfully prosecuted. So I think that we wouldn't have been buying it if we didn't think they have a reasonable amount of maneuver. We can't possibly rule out that they will, that they have some recourse to choose to take some recourse to shareholders. We can't rule that out at this point. But we do think that this isn't a distressed situation where equity shareholders are going to be materially affected. In our view, the banks have been very supportive throughout. Mark S says Rockwood seems largely balance sheet insensitive and seems to prefer distressed businesses. Is this because Harwood will support companies with emergency funding as at press? I can understand why you've come from this position, Mark, but we're not insensitive at all about balance sheets. We do a lot of work on about balance sheets. We think actually is that the average investor runs a mile very quickly as soon as they see any concerns in a balance sheet, rather than work out whether that balance sheet is truly distressed or not. So we would argue that a number of our holdings, we wouldn't argue that any of our holdings are per se distressed. We're comfortable that the cash generation of them can pay out. If you take and we're definitely not doing it so that we can offer pressure style tech style loans as a sort of last funding gap. If you think about it just from a straight portfolio perspective, we couldn't possibly allocate that amount of capital to offset the equity losses from having the distressed equity in a loan situation, which is why, for instance, with the pressure tech loan, I've written in that the moment it sells the PMC division, which they've announced that they're selling, all the money has to be paid immediately back to pay us back our loan, rather than sitting with quite a high coupon loan, fairly reflective of the risk in the business, but long term. Hopefully that's helpful. We're looking for businesses that either have net cash, like a Centaur Media, or a number of other holdings, or where they have balance sheets that are stretched, that we can see assets that can be disposed of, or long-term cash generation abilities, which means they should be able to have supportive banks or the ability to pay that debt down over the medium term through improved profitability. Andrew H isn't going to get an answer to this question. So he's asking me whether I'm going to buy or sell more shares in RM. So I'll partly answer it, I'm afraid, by saying there's absolutely no way I'm selling any RM shares. As explained earlier, we think it's worth 180 million quid. We know the banks are supportive, and there's absolutely no way we would sell any shares in that business. Full management team change, board improvements, no selling of RM. I've had one. I think I've pretty much done everyone, but there is one further one. Just quickly, what are your current observations on Filtronic? Very simplistically, this is one of our opportunity holdings, although we're doing over 5% of the portfolio. We're supportive of the new chair there, who's very experienced and focused on shareholder value. Filtronic's been around for many years, but it is re-emerging from the ashes of the previous issues that it had with regards to a new end market which has developed for low Earth orbiting satellites, which has been created by the amazing space re-entry technology that Elon Musk has developed within SpaceX, which is transforming the satellite industry. We think that Filtronic are on a pathway to potentially being a very important and strategic supplier into that satellite industry due to their world-leading RF capabilities. And to answer your question specifically, the current observations are most recently they've been winning the right contracts to suggest that pathway is there. If they continue along that ground, then sales are likely to increase quite materially, which will result in a material improvement in profitability at Filtronic and a creation of quite a lot of strategic value. I've taken up enough of everybody's time. Hopefully that was helpful for everyone. You appreciate with different audiences, just trying to make sure everyone's happy at the end of it. But thank you so much for it, and I'll hand back to Jake.
Richard, that's great. And thank you very much indeed for being so generous of your time then addressing all of those questions that came in from investors today. And of course, we'll be able to give you back all of the questions that were submitted, as well as any other ones that do come through just for you to review. And then we'll add those responses where appropriate to do so and publish them on the platform. But Richard, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Yep. Thank you, Jake. So just to remind you, we've got a value bias, we've got a small cap bias. We think the markets are depressed and probably nearer the end than the beginning on a turnaround in markets as interest rates start to fall at some point relatively soon. We've got significant specialist experience. It's definitely differentiated what we're doing. We think the returns are showing that it's proven. We stick with our target IRRs of 15% over the long term. That's absolute returns, not benchmark driven, making money for us and for shareholders over the medium term. We're 100% focused and aligned with you. And we are excited about deploying our capital in this current UK stock market, whilst others maybe get distracted by other things. So thank you very much, everybody, today.
Richard, that's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Rockwood Strategic PLC, we would like to thank you for attending today's presentation. That now concludes today's session. So good afternoon to you all.
Thanks very much.